Normally we do deep dives on shares, but today we are switching things up and going through an ETF.
Okay, you mentioned the ticker, but what we're talking about is the Vanguard Diversified High Growth ETF. And with that ticker that you just mentioned, VDHG. And this is part of Vanguard's suite of multi-sector ETFs that are composed of global and domestic equities, fixed interest, and cash. And this is just basically an efficient way for an investor to get a diversified portfolio across all those asset classes and sectors and regions. There's a low fee on this thing relative to a lot of the other active ETFs. And so that makes it appealing as well.
And as the high growth option, VDHG allocates 90% of the ETF to growth assets like shares and 10% to defensive assets like bonds. Additional ETFs provide access to conservative, balanced and high-growth portfolios, which are VDCO, VDBA, and VDGR.
Well, there we go. That's a lot of VD for this podcast. But we're going to talk a little bit about this ETF. And so we'll start with the process. So Vanguard has a group called the Asia Pacific Investment Strategy Group, and they're responsible for setting the strategic asset allocation for each ETF. And a strategic asset allocation is a long-term approach for allocating this ETF to those different asset classes that I was talking about. And the way that they do that is they use forecasts for long-term asset class returns. And on an annual basis, they may update the strategic asset allocation if there are changes or if there are updates to how something is being taxed. And that's really the process that they go through. Now, it's important to note that they do not use tactical asset allocation. So they're not going to change those allocations to those different asset classes based on market conditions.
The ETF is created using in-house index funds as building blocks. These index funds represent the major asset classes included in the ETF. Now, this is important and we'll get back to it. But first, we want to remind listeners that if you are considering VDHG, first focus on understanding the return you need to achieve your goal. VDHG allocates the highest percentage to growth assets of Vanguard's line of multi-sector ETFs. That higher allocation should deliver higher returns over the long term, but with a higher level of volatility.
Yeah, and of course, volatility refers to how much a portfolio bounces around in price. And volatility in the investment industry is synonymous with risk. But we've said this multiple times on here, right, Shani, that most long-term investors should be more concerned with achieving the return needed to reaching their goal and not focusing on the short-term risk of volatility.
And there we have it. This is a way for an investor to get a fully diversified portfolio in one trade, which is helpful if you want simplicity. But there is a potential price to be paid for that simplicity, which is what we're going to focus on in the podcast.
And that is what we told everyone to remember. And that is the way that this ETF gives investors exposure for lots of different asset classes, is because the ETF is just a wrapper around managed funds that track different indexes associated with all those asset classes.
And this is causing some investors to steer clear of this ETF. And their complaint is Vanguard's decision to construct VDHG out of the unlisted managed funds, which forces investors to pay the tax man and lose out on compounding.
And what these investors want is they want that wrapper ETF to hold other ETFs instead of managed funds. And in theory, this would be easy to do since Vanguard has ETFs and managed funds that track all of these indexes.
But ETFs and unlisted funds operate differently in practice. ETFs are bought and sold on a stock exchange via market makers, while investors trade unlisted fund shares directly with the fund manager.
And these differences in how ETFs and unlisted funds pay out or redeem investors leaving the fund matters. So when investors exit an unlisted fund, they're paid out in cash. If fund managers sell assets to get that cash, it can create capital gains for the fund's remaining investors. So those gains are passed on, those capital gains are passed on to investors as a taxable distribution. So in effect, investors leaving unlisted funds can leave behind capital gains taxes for those that remain.
And in theory, this dynamic applies to both ETFs and unlisted funds. In practice, ETFs can stream this tax bill away from the fund investors to their market makers. Market makers are financial middlemen who trade ETF units on behalf of fund managers. In doing so, the capital gains involved in redemptions are streamed to them.
So because VDHG is made up of unlisted funds, redemptions in the underlying funds can create these capital gains that we talked about. And these capital gains, you may miss them because they're added to the fund's overall distribution, which includes any interest income or dividends, but also, of course, these capital gains. And then you pay tax on these distributions, even if they're automatically reinvested.
Are you confused yet?
I'm always confused. As you said, I'm an old man, so everything confuses me.
Okay. So perhaps we can talk about how this works in practice. Differences range from a few tenths of a percent to more than 2%. For example, the Vanguard Australian Shares Index Fund has an annualized distribution of 4.62% over the past 5 years, slightly higher than the 4.19% from the ETF version. But that difference jumps to more than 2% for the ETF and unlisted versions of Vanguard's international shares over the same period.
And of course, the tax that's paid on distributions comes out of an investor's portfolio, and that, of course, slows the long-term growth. So more distributions means more tax and means less compounding. So to illustrate that, and this is from an article that we recently published, so we looked at what are the impacts on two hypothetical portfolios of investors. So the first mimics a wealthier investor, which simply means...
This can be your portfolio.
Oh, this is my portfolio? Yeah. If I was truly wealthy, I would not be sitting here doing this. But of course, the wealthier portfolio or the portfolio of a wealthier investor faces higher taxes. So if we start with $50,000, we make annual contributions of $15,000, and distributions are, as I said, taxed at that maximum marginal tax rate. And then the second portfolio is a less wealthy investor. So starts at $10,000, contributes $10,000 each year, and it's taxed at the penultimate rate.
So we modeled how each portfolio grew over 30 years when more of the return was paid as a distribution. Money paid out to the investor gets taxed and means less left to compound. We ran 3 scenarios with a total return of 8% annually. And because tax rates are different for everyone, we looked at a wealthy cohort at the highest marginal tax rate and a lower marginal tax rate for the non-wealthy cohort.
Okay, so bear in mind that these are all estimates because we don't know how much of future distributions will be based on dividends and how much will be capital gains. So this is history, but if the fund structure meant the capital gains portion of that distribution moved from 1% to 1.5%, it meant almost $100,000 less after 30 years. And that's in the wealthy example. In the non-wealthy example, it was $50,000 lower.
But the bottom line is that higher distributions lead to a smaller final portfolio. The impact is proportionally higher for larger portfolios at higher marginal tax rates. Please note that in practice, the difference is likely to be smaller. Most investors will pay less than the headline rate in tax, in part because capital gains are discounted. Higher distributions also reduce the ultimate tax bill on selling the portfolio due to a higher cost base.
Okay, that was a lot, like a lot of tax talk.
Yes,
and a lot of us talking on an audio format about this modeling and figures.
Yes.
But
there is an article though, so we'll pop it in the episode notes.
And so you can read that. But let us just summarize how investors should think about this. The taxes on VDHG will be higher than if an investor simply purchased the underlying ETFs. So every investor situation is, of course, unique, and there is certainly an appeal to an all-in-one solution like VDHG. However, there are ways to get the same exposure using a few Vanguard ETFs. These include Australian equity exposure using VAS, global equities through VGS, and fixed income through VAF. And all of those, or those 3 that I mentioned, they're all highly rated by our analysts.
And the two downsides to using multiple ETFs are the transaction fees and the need for a modest amount of effort to keep your asset allocation aligned to your objectives. If you're investing periodically, as many of us do, a simple rotation between the different ETFs in a portfolio limits transaction costs. This can be done in a way that keeps asset allocation largely in line with what you would get through a multi-sector product like VDHG.
And there's another advantage, Shani. And the other advantage is that the fees are lower. So VDHG charges 0.27% a year. VAS has a fee of 0.07%, VGS has a fee of 0.18%, and VAF has a fee of 0.10%. Of course, the advantage and what you're getting to pay more to VDHG is that they will automatically rebalance that portfolio. So it aligns with that strategic asset allocation. And that is valuable, especially for investors not contributing any additional money, because, of course, then they would have to rebalance by selling and buying, and there are transaction fees. But as Shani pointed out in her example, if an investor is still contributing, the rebalancing could be done without new contribution. So that is our episode. I mean, what would you do? Do you like this all-in-one ETF, or do you think you go for the underlying ETFs?
I do the underlying ETFs in practice, so that's what I do and what I would do.
Yeah, I would too, because obviously lower taxes are really important because we, of course, are trying to compound and build our portfolios. But thank you guys very much for listening. On the next episode, I'm sure there will be 6 or 7 other awards that Shani has won that I can talk about. If anyone has any questions, email me at my email address, which is in the show notes. Thank you.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.